Good morning, everyone. Today we're going to look at the analysis. I handed you out a formula sheet. Now, the biggest mistake most learners make when they think about the analysis is they think they don't have to learn the formulas because you get the formula sheet. What is the difference between this formula sheet and the one that you get in the exam? This one has the names of the formulas, which your one in your paper does not have. All right? And that's very important. Now remember, they will not change the order of the formulas. It will look exactly the same as this. So there's a few of them that you must learn. Some of them you know. So we're going to do them in groups, and I'm going to tell you what type of questions do you get with each one of them. So you must make notes now. When we do them, I will number them. You will see that they are numbered, and then we will speak about the different numbers for what do they, when do they use them, how do they use them, what must you answer when you get a question on that. So let's look at the first 6. Number 1 to 6 goes together. They all have to do with profitability. They have to do with profitability. In other words, if the question says, does the company manage their expenses well? Which company manages its expenses the better? You know you must look at the first 6. Now there's nothing to learn. There's only one that you have to learn, and that's number 2. Why do I say that? In all the others, they say, put your gross profit on sales. Put your net profit on sales. Put your operating expenses on sales. Number 2 is your markup. Your markup. Now you've learned from grade 9 that they say your sales, they give you the cost price, and they will say they have a markup of 50% on the cost price. All right, so that we've done since grade 9. What do they do now? Now they give you the sales and the cost of sales, and they ask you to calculate the percentage. All right, so markup is your gross profit on your cost of sales times 100. So what will happen now is they will say to you, the company uses a markup of, let's say, 60%. And at the end of the year, they take their income statement, and now they calculate their markup which they achieved during the year, and now they get, let's say they get 50%. So that means they didn't achieve their markup. Now they can ask you, what can be the reasons that this markup was not achieved? And that will be some things like what? What will cause you not to make your profit? Who can help me? What will cause a business not to make 60% but only 50%? Things like sales. You go by and they say less 50%, less 20%, up to 50%, and then nothing is 50%, it's only 20% in all the items. You see that in these clothing stores. All the boards say up to 50%, and when you get there, it's only 20%. That one thing that was 50% was sold already. So if they have a sale, that means they do not make the 60%. They only make a 50 or a 40 or a 30%. Theft will have an influence. Why theft? Why would theft have an influence on the markup? How do you call calculate cost of sales? Opening stock plus purchases plus carriage minus closing stock. So you purchased it, it makes part of your cost price, but it gets stolen, so what happens? You don't get the sales. Therefore, you will lose profit. All right. If you have a grocery store and the fruit or the veggies go bad, you have to throw them away. You purchase them, so they will have an influence on the markup. You will not get the markup that you were supposed to get. All right. They love to ask this one in paper 2 when we do stock evaluation. Next term we'll do stock evaluation. So then they love to ask that in paper 2. The others, they normally don't ask. Maybe they need 2 marks to get a question to a 40 or a 35 or a 50. They will ask those because they tell you what to do. I just want to show you one thing. The expenses on sales. The expenses on sales. That is number 5. Number 5, the expenses on sales. If it went from 10% to 20%, is that good or bad? Somebody? Good or bad? Bad, all right. Why? What does this actually mean? In straight language, it means for every 1 rand sales we have 10 cents expenses. So if a thing costs 10 rand, you will have 1 rand expenses. All right. This means for every 1 rand we have 20 cents of expenses. So that is bad. It's now more of your sales goes towards your expenses. So what will a company do? If this happens, one of 2 things could have happened during the year. The one is, my expenses increased, but my sales stayed the same, more or less the same. Or what can also happen? Expenses stayed the same, but your sales dropped, decreased. Then that percentage will increase. So what do? They look, if they see it was the expenses, then they can go and inspect all of their expenses and see which one of them got a big increase, and then they know they must manage that. All right. Or if their sales drop, they know they must go look at the products that they sell, and they must look at the marketing that they do. All right. So the first 6, very easy, normally 2 marks, and number 2 is the one that they ask normally in paper 2. They love to ask the question, which company manages its expenses the best? If they ask something like that, which company manages their expenses the best, or did they manage their expenses best? Which of those 6 will you use in your answer? Will you use number 1? Will you use number 1? No, because it has to do with gross profit. Number 2? No, gross profit and cost of sales. Number 3, net profit. That will give you an indication, am I right? Because if they manage it well, what will happen to your net profit percentage? It will increase, all right? The same with operating profit. You can use that. The expenses on sales and the net profit after tax. So the last 4, number 3, 4, 5, and 6, you will use in your answer, all right? Okay, so that is profitability. Now, the next one. The next one is number 7. Number 7 runs on its own. Solvency. Now, solvency has to do with my long-term debt. It has to do with your long-term debt. It runs on its own. In other words, the formula for solvency is total assets to total liabilities. And we always want our assets to be more than the liabilities. Just one thing before I forget that, when you have to do comment, when you have to do a comment on a ratio or on the question will say you have to give trends and you have to give figures. All right. So if they say trends, let's say the one thing that you must remember that when you do a ratio, it is always something to 1. The 1 is always on the right hand side. So if we have a solvency ratio of, let's say, 2,3 to 1, what does that mean? For every 1 rand liability, we have 2 rand 30 assets. So this company will be fine. If all the people want their money, all the creditors and the loans and want their money, you will be able to pay them. Now they say, let's say it was 3,6 to 1. Now what they meant by trends is you must say it decreased from 3,6 to 1 to 2,3 to 1. Don't say it decreased by 1,3. Never do that. Never do the buy stuff. All right. Whenever you do a ratio, you always say it was this and now it's that. Now, you will see later on, maybe when you do past papers, sometimes a learner would write 3,6 to 1, 2, 2,3 to 1. To 3 to 1. Saying that's a trend. Last year, when we marked, they decided that's not correct anymore. So I know a lot of teachers, I taught my learners to do that because it saves time. Last year in the exam, they decided it's not correct. We had a learner that lost 7 marks. She got 139 out of 150 for the paper. She lost 7 marks because she did that. She would say solvency ratio 3,6 arrow to 2,6. So they don't want us to write that anymore. They want us to write it decreased from 3,6 to 1 to 2,3 to 1. Or it increased if it was the other way around. All right. So never ever use arrows anymore. Even though your teachers tell you you can use it, they did not mark it. I phoned them and we had to mark it wrong. Okay. So assets, solvency ratio, long term, and your assets must be more than your liabilities. All right. So solvency, long term. Now the next one we look at, or they are a few, is number 8, 9, number 8, number 9, not number 10, number 11, 12, 13, and 14. They go together. Number 8, 9, 11, 12, 13, and 14. They all have to do with liquidity. Liquidity means it has to do with cash flow. All right. And what is the difference between liquidity and solvency? What's the difference between liquidity and solvency? Liquidity has to do with your short-term assets and short-term debts. All right. Now, short-term assets, in other words, it has to do with your current assets and your current liabilities. So most of these calculations, we will use your current assets and current liabilities. Now number 8, the current ratio. Number 8, current ratio. That is current assets to current liabilities. Now, maybe you will get something like this. It was 3,1 to 1. And now it is 5,6 to 1. Is that a good increase or not a good increase? It looks good, am I right? Because we had 3 rand 10 cents for every 1 rand liability, now we have 5 rand 60. But that's actually not good. This is actually not good. Why do I say that? Remember, what is your current assets? It's your inventory, your debtors, and your cash. All right. So that can mean that you have a lot of cash. You have a lot of cash in your bank account. And what happens if you have cash in your bank account? You don't get interest. What can you do with that cash? You can rather invest that in a fixed deposit. Then you will get, at least you will get interest. All right. So now it's difficult to say when is it too high or when is it too low. All right. The too low is easy, but the too high, I teach my learners, if it goes more than 4-1, it becomes a little bit too high. All right. If it's more than 4-1, it's not good for the business. It can mean one of two things. They have too much cash, or it can mean they have too much inventory. That can also be a problem. All right, we'll look at the inventory now. So, in the old days, we used to say there was a norm. Current ratio should be 2-1. So the answer was easy. If it was better than 2-1, you would say it's more than the norm of 2-1. But now they say we can't use a norm anymore because different businesses will have different norms. A jewelry shop, the value of their inventory will be very high, whereas a grocery shop, the value will not be so high. All right. So therefore, we can't use the norm anymore, but we keep that in our heads that we want it more or less 2-1. Now, how do we know we have too much stock in? Is we look at our asset test ratio. The next one. Now, you will see there's two number 9s. It's not a mistake. There's two ways in which you can do that. That's your asset test ratio. Now, let's say our current ratio was 3,1-1, and now we calculate your asset test ratio and you get 0,7-1. So what does that mean? For the asset test ratio, it's the same as the current ratio, but what did we do? We took out the inventory. All right. So if we take out the inventory, we see what? There's a big difference between those two. That means we have too much stock. Now the nice answer to give that they like to get is too much stock is tied up in cash. Because why will that have an influence on your cash flow? If you have too much stock, it means you have to pay for that stock and you don't get it sold. So now you have to pay for the stock and you don't get the money in for the selling of the stock. That will cause you a cash flow problem. All right. Why we say there's two number 9s? The one is if they give you the balance sheet, we take the current assets and we subtract the inventory. If they don't give us the balance sheet, you know current assets minus inventory is what? What's left? Your debtors and your cash and cash equivalents. So the other formulas say it's your cash plus your debtors in ratio to your current liabilities. This one, we want also, it's like solvency, we want our current assets, our liquid assets to be more than the liabilities. All right, we call them liquid assets, the cash and the debtors. We want them to be more than the current liabilities. So if there's a big difference, you can always know that there was too much stock. If there was not a big difference between those two and those two, then we know the cash will be our problem. We have too much cash in our bank account. We must rather put it in an investment. All right. Then number 11 and 12 goes together. Number 11 and 12. 11 and 12. The stock turnover rate and the average stock holding period. Now there's one thing that you must remember. Sometimes they will ask you, what is the stock holding period of the business? Then you take, if your stock holding period, you take your cost of sales, your average stock, your opening trading stock, closing trading stock divided by 2, and you divide that by cost of sales multiplied by 365. 5. That is an average. So sometimes they will ask you, how long will your closing stock last? Then you will just use the closing stock. So make sure, if they just ask you, calculate the stock holding period, you use the average. If they ask you how long the closing stock will last, you use the closing stock, only the closing stock. All right. There is not a good or bad answer because it depends on the type of business. Even with the stock turnover rate, it's just the opposite. Stock turnover rate, we take the cost of sales and we divide it by the average number of stock. Last year again, when we did the marking, some of these answers of this formulas are in percentages, some of them are days, some of them are cents figures, some of them are percentages. So if you are not sure what it is, just write the answer, not with days or anything. Because last year we had learners calculating the stock turnover rate, they calculated perfectly, but then they wrote percentage in the answer column. And immediately they lose that mark. So if you are not sure, is this now days or is it a percentage or what, just write the answer. Don't write anything else. All right. So stock turnover rate, and if you think about a clothing store, what would your stock turnover rate would you want it to be for a clothing store? How many times do you think must they sell out their stock? 2 to 4 times. Why? They want to sell out all the summer clothes and all the winter clothes because things change. All right. This year this thing is in fashion and next year it's not fashion anymore, so then they have to throw it away. So a clothing stock will be 2 to 4 times. A grocery store, maybe 12 times. Most people buy every month their groceries. All right. A hardware, maybe also 3-4 times, because their stock can't get bad or they must throw them out. It will last forever. All right. So it all depends. A bakery, maybe 150 times a year, because they want to sell out their stock nearly every day or every 2 days at least. You don't want to buy bread that was baked in January only in May. You want to buy it within the next 2 days. All right. So those two go together. Then number 13 and 14, they love them. Creditors are the debtors collection period and the creditors payment period. Debtors collection, your average debtors divided by the credit sales. If they don't give you the credit sales, you take your sales and you multiply that by 365. Now your debtors collection period, how long is that? Debtors collection, how long do we want that? 30 days, am I right? Debtors collection, we want it to be 30 days. So what is the question? They will say the debtors collection period for this year was 26 days and the next year it was 38 days. So what happens here? The debtors take too long. And now what will they ask? How do you get your debtors to pay you faster? And what's your answer then? Discounts, interest, SMS reminders or WhatsApp reminders. Send out your accounts on time. If you don't send out the account at the end of the month, they won't pay you before the end of the next month. All right. If you send out January's accounts only in March, you will only receive in April maybe, and then it's 4 months gone. All right. So we always must make sure that our accounts go out on time. Number 14, the creditors payment. What do we know about that? How long must that be? 60 to 90 days. Now, remember, your creditors, you are what for them? Debtors. And what do they want? 30 days. Now, what's the difference between your creditors and you're a debtor for them and your debtors? Why can you want your debtors to pay within 30 days, but you want them to wait for 60 to 90 days? Remember, if you buy in bulk. You buy a lot of stuff. So you will negotiate with them to take a little bit longer, because you first have to sell your stock before you can pay them. All right. These people, they only buy one pair of trousers or one pair of shoes, but you buy 20 pairs and 20 pairs of shoes. So you can negotiate with your creditors to take a little longer. But they, because they buy small number of stuff, you can ask them to pay within 30 days. And that's the difference between the two. All right. So what is the question that they ask? Comment on the liquidity of the business. So remember, they give you a table with all the ratios most of the times. So when you see liquidity, you must, in your head, know it's number 8, 9, 11, 12, 13, 14. You look for those that they gave you, and you use those. Maybe they say the liquidity improved or the liquidity did not improve, and you can see which one's improved, and then you use that ratios. All right. That all of these come from grade 11. That's nothing new, so you know all of them. Now we get to the new ones. Not all of them, but some of them are new. Now we look at number, I'm first going to leave out 15 and 16, I'll come back to them. Number 10 and 17 goes together. Number 10 and number 17 goes together. Number 10 is our debt equity ratio. I can never understand that somebody can get that one wrong. Why? They say, put your debt in ratio to your equity. It says what you have to do. Now, your debt equity has to do with risk. With risk. So, if a company, if the company has a debt equity ratio of 0.3 to 1, it means for every 1 rand liability, 1 rand equity, they have 30 cents worth of owner's equity, shareholders' equity. So that means this business will have a low risk. And that must be in your answer. When is it a high risk? When that is bigger than the 1. It's 1.2 to 1. Then it has a high risk. All right. Number 17 is your return on total capital employed. Return on total capital employed. I hear they talk about ROTCE. You can write ROTCE in your answer. They will know it's return on total capital employed. All right. This one, return on capital employed. Now the first thing, let's just quickly look at the formula. The formula says it's your net income before tax and before interest on loans. Now if you think back on your income statement, the format, what is your profit before income tax and before the interest? That was your operating income. Am I right? That's your operating income, because you have operating income, interest expense, income tax. So the operating income, they put on the average shareholders' equity and the average non-current loans. So what is capital employed? You must just make a note. Capital employed is your shareholders' equity plus your loan. Because sometimes in the questions, they will say to you, your capital employed is 3 million, and then they give you the loan, but they don't give you the shareholders' equity, or they give the shareholders' equity and they don't give you the loan, then you must know capital employed is those three things together. All right. So the return on capital employed, we always compare that to the interest of the loan, the interest rate on the loan. So if they say our ROTCE is, let's say, 20%, and our interest on the loan is 15%. What does that mean? They borrow money at 15%, but they make 20%. So now, with ROTCE, we have to use the word gearing. And we must say, is it a positive gearing or a negative gearing? So this will be what? A positive gearing. So normally it will count for 6 marks. They love to ask this for 6 marks. So they will say, comment on the risk and the gearing of the company. So now you must know, risk is my debt equity ratio. So 1 mark for the debt equity ratio. Then you will say the debt equity ratio decreased from 0.7 to 1 to 0.3 to 1. Another mark, because that is your difference between the two. And then you will say the risk is low, 3 marks. That's your 3 for that. Then on gearing, we know we must talk about the return on capital employed. So return on capital employed is bigger than the interest rate on the loan. Therefore, it has first you will say it increased from 17 to 20 or 25 to 20 decreased. It doesn't matter. You must say what happened. And then you will say positive gearing because the return is bigger than the interest rate on the loan. So that's 6 easy marks. And if you go and look through question number 3 in all the paper ones, 90% of the times that question will be there. Comment on risk, comment on gearing. Or they sometimes ask something. The company wants to borrow more money. Must they do that? So what must they do? What must I do? I must go look at my debt equity and I must go and look at my return on capital. So if I use that one, I always know those two will be in that question. All right. Sometimes I say, except for risk, what else must you do? Then you know it's return on capital employed. Now, we have, so that's number 10 and 17. They always go together. If there's a question, you can always know 10 and 17 will be together in your answer. Now we have number 15 and 16. And normally they go together. The return on shareholders' equity, number 15, is ROSH. Return on shareholders' equity. What's the difference between return on shareholders' equity and return on capital employed? The one difference is, who will be interested in the return on shareholders' equity? The shareholders. All right. So what do we compare this one to? The interest of our fixed deposit. Because remember, what could your shareholders do with their money? They could invest it in a bank. All right. So if my return on shareholders' equity is 15%, and they took that money and they invested in a bank, they would get 7%. So it would be much better for them to invest in the company. All right. So remember, shareholders' equity we compare to the fixed deposit. Return on capital employed we compare to the loan. So the shareholders are interested in this one. So who's interested in the return on capital employed? Who will be interested in that ratio? The directors, to see if they made money. The banks, the people lending money or borrowing money to the company. They would like to check that return on capital employed. All right. So this one, Rosh, number 16, the earnings per share, the EPS, earnings per share, the shareholders. That formula is the net profit divided by the number of shares. Now, earnings per share is always in cents per share. So you will take your net profit after tax, you will divide that by the number of shares, and you will multiply by 100 because you want the answer to be in cents per share. All right. If you give it in rands per share, they will mark it right. But now learners do the following. Let's say the net profit was 800,000 and you had 200,000 shares in issue. Now the learners get 4. All right. So what is that 4 rand or 4 cents? That's rand, because you took the rand figure and divided by the number of shares. If you want the cents, we have to multiply by 100, and then you get 400. Now again, what happened last year? The learners did this, and then they did this. And immediately, they lost that mark. All right. So if you are not sure, rather leave out the sign, because then they say the learner knew they had to multiply by 100 to get cents, so they will assume this one is in cents, and you will get your marks. All right. So earnings per share is net profit divided by the number of shares. Then we have number 18. Number 18. Our NAV, net asset value per share. What is my net assets? What is net assets? If I have 10 million rand of assets, that's my assets, am I right? But if I owe 8 million rand for that assets, is that 10 million still the value of my assets? No. What is the value net asset then? 2 million. The net assets value, or the net assets, is my assets minus liabilities. And assets minus liabilities is what? What's assets minus liabilities? Owner's equity. Am I right? AOL. Huh? So what is net asset value per share? What is my owner's equity per share? And what is my owner's or shareholder's equity? Share capital and retained income. All right. Now, whenever they ask a question on the share price, if they ask something about the price, what price must you issue the shares? Did they pay a correct figure for the shares? The buyback of shares, the shares were bought back at this price. Was that a good price? Anything they ask about the price of the share, you always use your net asset value and your market price in your answer. Net asset value tells you what is the value of your share. All right, what is it actually worth? So if my net asset value is 360 cents, how do we get that? Shareholders' equity divided by the number of shares. Market price. Where do we get the market price? On the JSE. Can you, as a director, influence that price? Can you decide the market price must now be 6 rand or 5 rand on? No. What determines this price? What determines the price of the shares on the market, on the JSE? What determines the price of anything in the world? Supply and demand. All right. So if my net asset value is 360 or 360 cents, and the market price is 320 cents, what does this tell you? Is this company doing good or not? Are they doing well or not? They're not doing well. Why? If they've done well, what will happen? There will be a demand for the shares. And if there's a demand for the shares, what will happen to the market price? The market price will increased. So what does this say? They say the value of the share is 360 cents, but the market are only willing to pay 320 cents. So they are not willing to pay what that share is actually worth. So there's no demand for the shares. Or if the company is not doing well, we see this in this Kleuterzone thing that they are doing now. It's all over the newspaper. It's nearly like Steinhoff. So what will happen to that market price? It will drop, because what will happen to the shareholders? They want to get rid of their shares. And if they want to get rid of their shares, the price, the demand, the supply will increase, therefore the price will drop. All right. Other way around. If the net asset value is 4 rand, 400 cents, but the market price is 450 cents. Now the market price is 450 cents. What does that tell you? There's a demand for the shares. This company, they expect this net asset value, this company to do even better in the future. Therefore, they are willing to pay more, because they believe that that market price will still increase a lot more. And why do you buy shares? Why do you invest in shares? You want the market price to increase so that you can sell them at a profit. You want to buy them for 4.50 but to sell them for 6 rand so that you can make a profit. All right. So whenever they ask something about the price, so they can ask you, you can buy this share for 4.30. Will you buy them? What do I see? Yes, no? Yes, I hear a lot of yeses. 4.30. People saying yes will say, I'm getting a value, I'm paying something that I can maybe then sell for 4.50. If I pay 4.30, I can make a profit immediately. Other people will say, no, the value of that share is 4 rand. I'm not willing to pay 4.30. So there's a yes and a no answer. All right. So some people look at the net asset value, and some people look at the market price to determine whether they will buy that share. All right. Then we have the dividends per share. Now I quickly want to show you something about the dividends per share. What will happen? Remember, if we have dividends, we have the interim dividend and we have the final dividends. All right. So let's say the interim dividends was 80,000 and the final dividends was 100,000. So that means our dividends for the year was 180,000. Now they say calculate the dividends per share. So most learners will take this 180,000 and divide that by the number of shares at the end of the year. But that's not actually correct. They don't want you to do that. They want you to look how many shares did that 80,000 get that dividends, and how many shares got the 100,000. So let's say you had 80,000 shares at the beginning of the year. I'm just going to use round figures. We had 80,000 shares at the beginning of the year, and let's say after the interim dividend, we issued another 20,000 shares. Now we have 100,000 shares. So if you take that 180,000 and divide that by 100,000, we get 18 cents per share. Am I right? What happened here? If we look at the interim dividends, it was for 80,000 shares, so each share got 1 rand. Am I right? And for the 100,000, we had 100,000, so each one of them got 1 rand. So that gives you 2 rands per share, which is not 1 rand 80 per share. All right, so there's a difference. So when they want you to calculate the dividends per share, always make sure that you calculate your interim dividend per share, calculate your final dividend per share, and then add the two together. They will normally work out in round figures. Normally they will work out in round figures. So Or they will say to you, the interim dividend was 1 rand per share, now you must calculate the final dividend and then add those two figures together. Don't take the total dividends and divide that by the number of shares. All right. Then there's one that's not on the formula sheet. There's a ratio that's not there, and that is your dividend payout rate. The dividend payout rate. What is dividend payout rate? Remember, what is your dividends? Dividends is the net profit that we give to our shareholders. All right. So the dividend payout rate, it is not on your formula sheet, but it's nearly in every question. This is your dividends divided by your earnings per share times 100, because you want a percentage, a rate. A rate is a percentage. So if my dividend rate, payout rate is 60%, it means of every 1 rand dividend, earnings per share, I gave out 60 cents dividends. All right. So if it's 60%, what does that mean? They did not give out all their profits. That means they are retaining some of their profits, and that means that business wants to expand because they retain some of their profits. If my dividend rate is 100%, what does that mean? They gave out all their profits. And if they give out all their profits as dividends, it means they do not want to expand. That's all you have to remember. All right. So sometimes they will say the one company is this and the other one is this. This company do not want to expand. This one wants to expand. Or they say the directors changed from this to that. They wanted to expand last year, but they decided not to expand any further. Therefore, they are giving out the profits. The other thing, what can happen here, if they do that, is they can try to keep the shareholders happy. The company did not that very good. The financial statements does not look very, very good. So therefore, they want to keep the shareholders happy. Now they give a bigger dividend than they were actually supposed to give that. All right. Any questions? All right. Next week, what do you want us to look at again before the test? We have one class. Balance sheet. One with ratios. Maybe we should look at one where they use ratios. All right. So then we'll do that next week before the test. All right.